Before we dive in, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage lender, or underwriter. The information provided is not legal or financial advice. You should always consult with a qualified professional for advice tailored to your specific situation. Your bank statement is telling a secret story about you. And right now, a mortgage underwriter, someone you will never meet, is reading that story like a detective novel. They're looking for clues, for plot holes, for any sign of risk. And if they don't like the story your bank statements tell, they will deny your home loan. It doesn't matter if you have an 800 credit score. It doesn't matter if you have a great job. A few innocent transactions you never thought twice about can completely derail your dream of owning a home. Imagine this for a second: you found it. The perfect house. You've saved for years, you've polished your credit, you've got the pre-approval letter in hand. You submit the final application, feeling that rush of excitement. Then your loan officer calls. But the tone is off. They say, "The underwriter has a few questions about your bank statements." And your heart plummets into your stomach. Suddenly, that $50 you Venmo'd your buddy every week for your fantasy football league, or that big cash deposit from selling your old car on Craigslist, they're not just transactions anymore. They're evidence. And you're the prime suspect. This is the reality that blindsides thousands of homebuyers every single year. They focus so much on credit scores and down payments that they completely forget the single most scrutinized document in the entire mortgage process: your bank statement. They think the lender just wants to see if you have enough money in the account. That's not even half the story. They are performing a financial forensic audit on your life. They're looking for stability, they're looking for consistency, and most of all, they're looking for undisclosed risk. So in this video, I am pulling back the curtain. We are going deep inside the mind of a mortgage underwriter. I'm going to show you the exact red flags they are trained to hunt for on your bank statements. We're not just talking about the obvious stuff. We're talking about the subtle, sneaky mistakes that get perfectly qualified people denied every single day. And more importantly, I'm going to give you a step-by-step playbook on how to prepare your bank statements, how to explain the tricky situations, and how to make your financial story so clean, so straightforward, that the underwriter has no choice but to stamp approved on your file. Let's get started with the number one loan killer. The red flag that causes more underwriting headaches than anything else. Large undocumented cash deposits. An underwriter is scanning through your last 2, sometimes 3 months of bank statements. They see your paychecks coming in, regular as clockwork. Good. They see your rent payment going out. Good. Then boom, a random deposit for $8,000. There's no company name next to it. It doesn't match your payroll deposits. To you, this might be a totally innocent gift from your parents to help with closing costs. But to an underwriter, a giant flashing neon sign just lit up that says risk. Why? Because their mind immediately jumps to one of 3 scary possibilities. Possibility 1. This is an undisclosed loan. Maybe your uncle lent you that $8,000 and you have to pay him back every month. That's a new debt that isn't on your credit report, and it instantly messes up your debt-to-income ratio. If they can't prove it's not a loan, they have to assume it is a loan. Loan denied. Possibility 2. This is illicit or unstable income. Did you get paid in cash for a side hustle you didn't put on your application? To a lender, undocumented income is unusable income. They can't count on it to be there next month to help you pay the mortgage. So they disregard it entirely, and if you were counting on that money for your down payment, you're in trouble. Possibility 3. It's a cash advance from a credit card or some other high-interest loan you took out just to fudge your bank balance. This signals financial desperation, the exact opposite of what a lender wants to see. So what is considered a large deposit? There's no single dollar amount. The rule of thumb is any single non-payroll deposit that is greater than 50% of your total monthly qualifying income. So if you make $6,000 a month, any single deposit over $3,000 is going to get flagged for review. Some lenders are even stricter, looking at 25% or any deposit over $1,000. So how do you fix this? The answer is simple. Create a paper trail for everything. You have to be able to source and season your funds. Sourcing means proving where the money came from. Seasoning means showing the money has been in your account for a certain period, typically at least 60 days, or 2 full bank statement cycles. If you're getting a gift from a relative, it's not enough to just deposit the cash. You need a formal gift letter. This is a signed document that states the giver's name, their relationship to you, the exact dollar amount, the date of the transfer, And this is the most important part. A sentence that explicitly says, "This is a gift and no repayment is expected or required." The lender will then also need to see proof that the giver had the funds to give, which means they might ask for the giver's bank statement showing the money being withdrawn. Yes, it's that invasive. If you sold something like a car or a piece of furniture, you need a bill of sale. It should have the buyer's name, what you sold, the price, and both of your signatures. You also need a copy of the check or money order, and a copy of the vehicle title you signed over. You have to connect the dots for the underwriter so they don't have to guess. The absolute worst thing you can do is deposit cash. It's almost impossible to source. If you have cash saved up at home, mattress money, you need to deposit it into your account at least 60 to 90 days before you even think about applying for a loan. Let it sit there. Let it season. Once it's been in your account for over 2 statement cycles, the lender generally won't ask about it anymore because it's now considered your asset. The second major red flag that underwriters look for is a pattern of insufficient funds or overdrafts. This is a direct reflection of your financial management skills. Think about it from the lender's perspective. They are about to lend you hundreds of thousands of dollars, a debt you'll be paying back for the next 30 years. When they look at your checking account and see an NSF fee, a non-sufficient funds fee, or see your balance dip into the negative, even if you have overdraft protection, it sends a powerful message. This person struggles to manage the money they have right now. How can we trust them to manage a mortgage payment, which will likely be the biggest payment they've ever had? Even a single overdraft in the last 60 days can be a problem. More than one is a serious red flag. It suggests you're living paycheck to paycheck, or worse, you're not paying attention to your finances. Lenders want to see a stable, consistent cushion in your account. They want to see that after all your bills are paid, there's still a healthy positive balance. Many people think, "Oh, I have overdraft protection, so it's not a big deal." Wrong. The underwriter sees everything. They see the transaction that caused the overdraft. They see the transfer from your savings or the line of credit that covered it. And they see the fee the bank charged you. It all tells that same story of financial instability. The solution here is proactive and requires discipline. At least 3 months before you apply for a mortgage, you need to treat your checking account like it's on a job interview. Balance it meticulously. Set up low balance alerts on your banking app so you get a text when your account drops below, say, $500. Stop any automatic payments for things you no longer use. Know exactly when your direct deposit hits and when your major bills like rent and car payments are scheduled to come out. The goal is to have 2 to 3 squeaky clean bank statements with 0 overdrafts and no evidence of financial scrambling. If you do have an unavoidable overdraft from a legitimate bank error, be prepared to write a letter of explanation, or LOX, detailing exactly what happened. But relying on that is a weak position. The best strategy is to prevent it from ever happening in the first place. Now, beyond overdrafts, the single biggest red flag that will stop an underwriter dead in their tracks is a large, unsourced cash deposit. This is the big one. This is the one that causes the most mortgage denials out of anything we see on a bank statement. You might be thinking, what's the big deal? I saved up cash, I sold my car, my grandma gave me 10 grand for my birthday. It's my money. Why does the bank care where it came from? It's a fair question, but you have to understand the world the lender lives in. They aren't just being nosy. They are legally bound by federal anti-money laundering laws, like the Bank Secrecy Act and the Patriot Act. These laws require them to verify the source of any large sum of money used in a real estate transaction. They have a legal obligation to ensure that the funds aren't from illicit activities, and just as importantly for your mortgage approval, that the money isn't a secret loan in disguise. Think about it from their perspective. If you suddenly deposit $10,000, how do they know it's not a loan from a friend that you have to pay back every month? A loan that isn't on your credit report? That secret monthly payment would completely change your debt-to-income ratio and could mean you no longer qualify for the mortgage. So they have to assume the worst until you can prove otherwise. So what counts as a large deposit? There's a rule of thumb most underwriters use. Any single, non-payroll deposit that is greater than 50% of your total monthly qualifying income will be flagged. So if you and your spouse are qualified based on a combined income of $10,000 a month, any single deposit over $5,000 is going to get a magnifying glass taken to it. Some lenders are even stricter, flagging deposits as low as 25% or any amount over $1,000. The key is, it's not your regular direct deposited paycheck. Let's walk through the 3 most common scenarios where good people get into trouble with this. First, there's the cash under the mattress scenario. Let's say you're a bartender, a server, or anyone who gets paid a lot in cash tips. For years, you've been stashing away a few $100s a week in a safe at home. You've saved up $20,000. A month before you apply for a mortgage, you walk into your bank and deposit that entire 20 grand. To you, it's the proud result of years of hard work. To an underwriter, it's a massive, unsourced, untraceable deposit that just appeared out of thin air. You can't prove where it came from. You have no pay stubs for it, no paper trail. That $20,000 is now considered unseasoned and is basically unusable for your down payment or closing costs. Your loan is very likely to be denied. The second scenario is the gift from family. Your parents are amazing, and they want to help you with a down payment. They transfer $30,000 into your checking account. A week later, you apply for a mortgage. The underwriter sees this huge transfer and immediately flags it. Is it a gift or is it a loan? Without documentation, they have to assume it's a loan. This is an easy fix, but you have to do it the right way before the money ever moves. The correct procedure is to get a gift letter from your parents. This is a formal document stating that the money is a true gift, with no expectation of repayment. It needs to be signed by them, and it needs to specify the amount and the property it's for. Then you need a paper trail. You need a copy of your parents' bank statement showing the money leaving their account, and your statement showing it arriving. Don't just accept a Zelle or a Venmo. You need a clean wire transfer or cashier's check that can be easily traced from their account to yours. With a gift letter and a clear paper trail, that $30,000 is perfectly acceptable. Without it, it's a deal killer. The third scenario is the private sale, or side hustle. You sell your old Honda Civic on Craigslist for $7,000 cash. You deposit the cash. The underwriter flags it. The solution? Documentation. You need a formal bill of sale, signed by both you and the buyer, with the vehicle's VIN, the sale price, and the date. You should also include a copy of the vehicle's title to show you owned it. The same goes for side work. If you did a freelance web design project for $2,000 and the client paid you, you need a copy of the invoice and a copy of their cleared check or wire transfer. The rule is simple. If you can't document it, you can't use it. This brings us to two critical concepts: sourcing and seasoning. Sourcing is what we've been talking about, providing the paper trail to prove where the money came from. A gift letter, a bill of sale, an invoice. But seasoning is the ultimate pro-level strategy. Seasoning simply means leaving the money in your account for a long enough period of time that the lender no longer needs to source it. How long? Typically 60 days. Lenders usually only require your two most recent bank statements. So, if that $20,000 in cash tips has been sitting in your savings account for 3 months, it will appear on 3 consecutive statements. By the time you apply, the initial deposit is no longer on the 2 statements you have to provide. The money is now considered seasoned. It's part of your established financial history. It's your money, no questions asked. So if you're planning to buy a house in the next 6 months and you have cash you want to use, deposit it now. Let it season. Don't wait until the last minute. So, we've established that big money coming in gets scrutinized. But what about the money going out? Can a simple payment you make every month also torpedo your mortgage application? Absolutely. When an underwriter scans your withdrawals and payments, they aren't looking for your Starbucks habit or your Netflix subscription. They are hunting for one thing: undisclosed debt. They are looking for regular, recurring payments to a person or an entity that doesn't show up on your credit report. Here's the classic example. Every month for the last year, you've sent a $500 Venmo to your Uncle Bob. On your statement, it just says Venmo payment Bob Smith. The underwriter has no idea what that is, but they are trained to assume the worst. Their first thought is that you bought a car from Uncle Bob and this is your monthly payment. Or it's a personal loan he gave you for a business venture. They will treat that $500 as a monthly debt payment, even though it's not on your credit report. They will add it to your debt-to-income ratio. If you were already on the edge of qualifying, that extra $500 payment just pushed you over the limit. Your loan is denied. In reality, you might just be helping Uncle Bob with his rent. It's a gift, not a debt. But how do you prove that? You'll have to get a detailed letter of explanation, and you'll likely need a signed letter from Uncle Bob himself, confirming that it's not a loan and you have no obligation to pay him. It's a huge hassle, it delays your closing, and it puts your entire loan at risk. The same goes for payments to a credit repair company. Lenders see that as a massive red flag that you're trying to manipulate your credit score. They also look for payments to other mortgage lenders or rental companies. If you're paying another mortgage that you didn't disclose on your application, that's fraud. If you're making payments that look like rent when you claimed you were living with your parents rent-free, that's a major inconsistency. Even large cash withdrawals can be a problem, especially right before closing. If you pull out $5,000 in cash a week before you're supposed to sign the papers, the lender will want to know why. Are you using it for a down payment on a new car you didn't tell them about? Are you paying off a private lender? Again, it creates suspicion and requires more paperwork and explanations. The lesson here is to keep your financial activity as clean and simple as possible during the loan process. Avoid any unusual payments or transfers. If you have to make one, like paying your cousin back for a concert ticket, do it with a clear memo and be prepared to explain it. So we've covered money coming in and money going out. But what about the money that's supposed to be there consistently but isn't? We're talking about your income. For most people with a simple W-2 job and direct deposit, this is straightforward. But for anyone with variable income, salespeople on commission, freelancers, small business owners, proving your income is one of the trickiest and most frustrating hurdles to clear. And the way it shows up or doesn't show up on your bank statement can make or break your entire approval. So let's talk about what that looks like from the underwriter's chair. They pull up your bank statements and they aren't looking for a single massive deposit. In fact, a huge one-time deposit that's out of character can be a giant red flag, not a green light. What they're looking for is the most boring word in the English language: consistency. They are trying to build a predictable story about your financial future based on the evidence of your recent past. For a W-2 employee with a salary, this story is simple. Every 2 weeks, a deposit for $2,453.12 hits their account from the same source. It's a predictable, repeatable pattern. The lender can look at that and say, okay, we can reasonably expect this to continue for the foreseeable future. But for you, the freelancer, the business owner, the sales professional, your story is a chaotic novel. 1 month you land a massive project and deposit $20,000. The next month is dry and you only bring in $3,000. The month after that, you have 5 different clients paying you 5 different amounts on 5 different days. To an underwriter, this isn't a story of success. It's a story of volatility. And volatility is risk. Their job is to eliminate risk. So how do they do it? They average it. This is the single most important concept for any non-traditional earner to understand. Lenders will typically ask for 2 years of tax returns and will calculate your average monthly income over that 24-month period. They take your total net income from 2 years ago, add it to your total net income from last year, and divide the whole thing by 24. That number, that much lower, much more conservative number, is the income they will use to qualify you for the loan. That one spectacular month you had? It gets watered down by 23 other months. That one terrible quarter? It drags your entire average down. And here's the kicker. If your income has declined from 1 year to the next, they'll punish you even more. Let's say 2 years ago you made $120,000, but last year you only made $90,000. They will not average the two. They will almost always use the lower, more recent figure of $90,000. Why? Because it shows a downward trend, and to them, a downward trend is a 5-alarm fire. They'll base your entire loan qualification on that lower, more recent income, or potentially an even lower average from the last 12 months. Now, how does this connect back to your bank statements? The bank statements are the proof. They are the evidence that corroborates the story you're telling them in your tax returns. The underwriter is going to meticulously scan your deposits to see if they match the income you're claiming. They want to see regular, repeated deposits coming into your account. If you claim you make, on average, $8,000 a month, they better see deposits that add up to something in that ballpark month after month. This brings us to one of the most common and most fatal mistakes that self-employed people make: commingling funds. This is the technical term for mixing your business and personal finances in one bank account. You pay for your business software and your family's groceries from the same checking account. A client pays an invoice and the money lands in the same account you used to pay your personal car note. To you, it's just convenient. To an underwriter, it's an absolute nightmare. It makes it impossible for them to differentiate legitimate business revenue from a personal transfer. Imagine their perspective. They see a $10,000 deposit. Is that from a client, which is real, provable income? Or did you just transfer it from your savings account to cover your bills? They see a $500 Zelle payment. Is that a customer paying you, or was that your buddy paying you back for concert tickets? They have no way of knowing, and their default position is to be suspicious. If they cannot clearly source and verify a deposit as legitimate business income, They will disregard it. They will simply not count it towards your qualifying income. You could have $10,000 in deposits, but if they can only definitively prove $5,000 of it is business income, then as far as they're concerned, you only made $5,000 that month. This is why the single best piece of advice for any business owner, freelancer, or independent contractor is to have separate, dedicated bank accounts. One for business, one for personal. Period. No exceptions. All your business revenue, every single dollar from every client goes into the business account. All your business expenses get paid out of that business account. Then you pay yourself. You set up a regular, recurring transfer from your business account to your personal account. Treat it like a paycheck. Maybe it's $5,000 on the 1st and 15th of every month. What does this do? It creates that magic word: consistency. Now, when the underwriter looks at your personal bank statement, the one you're actually using for the mortgage, they don't see a chaotic mess of client payments and business expenses. They see a clean, predictable pattern. A $5,000 deposit on the 1st from my business LLC, and another $5,000 deposit on the 15th from my business LLC. Suddenly, your unpredictable income looks exactly like a reliable biweekly paycheck. You've made the underwriter's job easy. You've taken a complex story and made it simple. And in the world of mortgage lending, simple gets approved. They will still want to see your business bank statements to verify the revenue coming in, but the whole picture is now cleaner, more professional, and infinitely easier to approve. It shows you're organized and that your business is a legitimate, functioning entity, not just a hobby you run out of your personal Venmo account. But even if you do all of this perfectly, there are still traps hiding in plain sight on your statements. What about large, irregular deposits? Maybe you're not self-employed. You have a regular job, but you sold your old car for $6,000 cash and deposited it. Or maybe your parents gave you $10,000 to help with the down payment. You might think, great, more money in the bank, this looks good for me. But you couldn't be more wrong. To an underwriter, a large, sudden, and undocumented deposit isn't an asset. It's a potential liability. It's a giant question mark that they are required by federal law to resolve. That single deposit could be an undisclosed loan from a relative, a cash advance from a credit card, or any number of things that represent debt you haven't told them about. An undisclosed debt is the poison that kills mortgage approvals. That one innocent deposit can grind your entire application to a halt, triggering a cascade of questions and demands for documentation that can feel like a full-blown investigation. So what does this investigation actually look like? It starts with a simple, almost deceptively polite request from your loan processor or underwriter. It will come in an email with the subject line like "condition on your loan," and it will ask for something called a letter of explanation, or unlocks. This is the underwriter's primary tool for discovery. It's their way of saying, "I see something here that doesn't make sense. Explain it now." And your response to this request can either be the key that unlocks your mortgage approval, or the first shovel of dirt on its grave. Let me paint you a picture. Let's talk about a couple. We'll call them David and Emily. They're perfect applicants on paper. Great credit scores, solid income, been saving for years. They're about 3 weeks from closing on their dream home. They're picking out paint colors, arguing about furniture, the whole 9 yards. Life is good. Then the email arrives. The underwriter has flagged a single deposit on their most recent bank statement. It was for $7,000. The underwriter asks for a letter of explanation. David and Emily aren't worried. That was a gift. Emily's parents sold their old ski boat and gave them the cash to help with closing costs. It was a wonderful, generous gesture. So David quickly types up a reply. The $7,000 deposit on May 15th was a gift from my wife's parents. Thanks, David. He hits send, leans back and thinks, problem solved. He could not be more wrong. What he just did was hand the underwriter a brand new bright red flag. Because in the lender's world, the word gift isn't an explanation. It's the beginning of a whole new line of questioning. A few hours later, the next email arrives. The underwriter's response is polite but firm. Thank you for the explanation. We will now require the following: a fully executed gift letter, signed by you, your wife, and her parents. We will also need a copy of the bank statement from your wife's parents, showing they had the $7,000 to give. And finally, we need proof that the funds left their account and were deposited into yours, which means a copy of the canceled check or the wire transfer receipt. Suddenly, David and Emily's dream is turning into a nightmare. They now have to go back to their generous in-laws and ask them for their private bank statements. It's awkward. It's invasive. Emily's dad is a proud, old-school guy. He's offended. Why do they need to see my bank account? The money is a gift, not a loan. I don't want some stranger looking at my finances. He's right to feel that way, but his feelings don't matter to the underwriter. The underwriter has a rulebook, and right now David and Emily are on the wrong side of it. Their closing date is looming, and their loan is completely stalled. All because of a simple gift. Why? Why this insanity? Is the lender just trying to be difficult? No. The lender is terrified of two things: undisclosed debt and money laundering. They are legally required, under federal laws like the Patriot Act, to source all large, non-payroll deposits. They have to prove to the government that the money used for your down payment didn't come from illegal activities, or more commonly, from a secret loan that you're not disclosing. Think about it from their perspective. That $7,000 from Emily's parents? How does the lender know it wasn't a loan from a shady friend who expects to be paid back $1,000 a month? That's $1,000 a month that doesn't show up in your debt-to-income ratio. If they approve your mortgage and you default because you're secretly paying back this gift, the entire loan is at risk. The government can impose massive fines on the lender for failing to do their due diligence. So they don't play games. Every large, non-payroll deposit must have a clean, verifiable paper trail. No exceptions. So how could David and Emily have avoided this entire nightmare? By understanding the rules of the game before they started playing. The solution is simple, but it requires foresight. It's all about creating that paper trail proactively so the underwriter never even has to ask. If you're expecting a gift, here is the bulletproof method. First, the money needs to move in a traceable way. Cash is your worst enemy. A pile of $20 bills is the reddest of red flags. It's untraceable and screams mattress money or worse. The money must be transferred via a cashier's check or a wire transfer. This creates an instant third-party record of the transaction. Second, before the money is even sent, you need a gift letter. You can find a standard template online. It's a simple one-page document that states the giver's name and address, your name, the amount of the gift, and most importantly, a single magical sentence. This is a bona fide gift, and there is no expectation of repayment. Both you and the gift giver sign it. Now you have a legal document that preemptively answers the underwriter's biggest fear. Third, when the money arrives in your account, you keep a copy of the wire transfer receipt or the deposited cashier's check. Now you have the complete story, documented from start to finish. A signed letter stating intent, a bank record of the money leaving the giver's account, and a bank record of it arriving in yours. When the underwriter sees that $7,000 deposit, you don't just send a one-sentence email. You send them a polite, professional package containing the signed gift letter and the transfer receipt. You haven't just answered their question, you've solved the entire puzzle for them. The underwriter sees this and breathes a sigh of relief. This applicant is organized. They understand the process. They're low risk. They check the box and move on. No stress, no invasive questions, no awkward conversations with family. This principle applies to any large deposit. Sold your car on Craigslist for $5,000? You better have a copy of the bill of sale, a copy of the signed over title, and a copy of the check from the buyer. If the buyer paid you in cash, you have a major problem. You should deposit that cash into your account, get a receipt, and immediately draft a detailed letter of explanation, but be prepared for scrutiny. Got your annual bonus? Great, but if it's deposited separately from your regular paycheck, you'll need to provide the pay stub that breaks down the bonus amount. Cashed out some stocks to help with the down payment? The underwriter will want to see the brokerage statement showing the sale of the securities and the subsequent transfer of funds into your checking account. Received a tax refund? You'll need the page from your tax return showing the expected refund amount to match the deposit. The golden rule is this: every dollar needs a story, and every story needs a receipt. The underwriter is a detective, and your bank statement is the scene of the crime. Your job is to leave no unsolved mysteries. If you can't prove with a third-party document where the money came from, the underwriter by default must assume the worst-case scenario. It's a loan, and that assumption will kill your deal. This is why the best loan officers will tell you, don't move any large sums of money for at least 3 months before you apply for a mortgage. Let the funds season. What does seasoning mean? It's a banking term for letting money sit in your account long enough that the lender considers it your own, no questions asked. The standard period is 60 days, or 2 full bank statement cycles. If a large deposit appeared on a statement 3 months ago, the underwriter won't even see it, because they typically only ask for the last 2 months of statements. That $10,000 gift from your aunt? If it's been sitting in your savings account for 90 days, it's just part of your balance. It's seasoned. It's safe. So you've mastered your deposits. Every dollar coming in has a name, a story, and a paper trail. You've made the underwriter's job a breeze. But what about the money going out? Because if your deposits tell a story of where your money comes from, your withdrawals and spending habits tell an even more critical story. The story of your financial discipline. And one single, tiny fee on your statement can reveal a pattern of behavior that screams high risk louder than anything else. We're talking about the dreaded NSF fee, the overdraft. It's a tiny charge that tells the lender you're living so close to the edge, you sometimes fall off. And that is a terrifying prospect for someone about to lend you hundreds of thousands of dollars. Think about it from their perspective. They're not just lending you money. They're betting on your financial stability for the next 30 years. An overdraft fee is a signal, a flashing red light on their dashboard, that suggests you're driving with the gas light on. A single NSF fee might be explainable. Maybe your direct deposit was a day late, and an automatic payment went through a day early. These things happen. But if they see a pattern, 2, 3, or more overdrafts in a 60-day period, the conversation changes dramatically. It's no longer an anomaly, it's a habit. It tells the underwriter that you don't have a financial buffer. You don't have that cushion between your income and your expenses. And if you can't manage a $35 checking account fee, how in the world are you going to manage a $3,000 mortgage payment when your water heater inevitably explodes? So if you have one, be prepared to write what's called a letter of explanation or LOX. You'll need to own it, explain clearly and concisely what happened, and most importantly, assure them it was an isolated incident that won't happen again. But if it's a pattern, there's no letter of explanation that can fix the story your bank statement is already telling. The best cure is prevention. Wait until you have at least 3 months of clean statements with no overdrafts before you even think about applying. It proves you've corrected the behavior and established a new, more stable baseline. But it's not just about the money you don't have. It's also about the money you suddenly do. This brings us to the next giant, pulsating red flag for lenders. Large unexplained deposits. You might think, wait a minute, I thought having more money was a good thing. And you're right, it is. But only if the lender knows exactly where that money came from. An underwriter's job is to be a financial detective. Your bank statements are their primary crime scene. And a large random deposit is like finding a mysterious briefcase full of cash. They have one question and one question only. Where did this come from? Their fear isn't that you have too much money. Their fear is that this deposit is actually a secret loan. A loan from a family member, a friend, a shady lender, it doesn't matter. If it's a loan, it's a debt. And if it's a debt that doesn't appear on your credit report, then the debt-to-income ratio they calculated for you is a lie. It's fraudulent. That $10,000 deposit from Aunt Carol might look like a generous gift. But if you have a private arrangement to pay her back $200 a month, that's an undisclosed liability. That's $200 a month that you can't use to pay your mortgage if you get into trouble. This is the kind of thing that keeps underwriters up at night. So what qualifies as a large deposit? There isn't a universal dollar amount. It's all relative. The general rule of thumb used by Fannie Mae and Freddie Mac, the giants who set the rules for most mortgages in America, is any single deposit that exceeds 50% of your total monthly qualifying income. So if your gross income is $6,000 a month, any single deposit over $3,000 that isn't from your regular payroll is going to get flagged. Some lenders are even stricter, flagging anything over 25%, or even any non-payroll deposit over $1,000, period. They will go through your statements with a highlighter, and every single one of these deposits will require a full explanation and a paper trail. This is where you learn the two most important words in mortgage underwriting: sourced and seasoned. For funds to be acceptable for your down payment or closing costs, they must be sourced and seasoned. Sourced means you can prove the legal origin of the money. Seasoned means the money has been in your account for a long enough period for the lender to consider it your own asset, not a recent loan. The standard seasoning period is 60 days. This is not a coincidence. It is the entire reason lenders require, at minimum, your last 2 months of bank statements. They want to see the full 60-day seasoning period. Any large deposit that appears on those statements is considered unseasoned and must be sourced. If you had a big chunk of money sitting in your account for 6 months, They don't care where it came from. It's seasoned. It's yours. But a $10,000 wire transfer that hit your account last Tuesday? You better believe you're going to have to explain it. So how do you do that? Let's break down the common scenarios. Scenario number 1. The money is a genuine gift from a relative. This is incredibly common and perfectly acceptable, but it requires a very specific process. You can't just have your mom transfer you 20 grand. First, you need a gift letter. This is a formal document that the lender will provide. It needs to be signed by both you and the person giving the gift. The letter explicitly states the amount of the gift, the date it was transferred, and contains the most critical sentence in the entire transaction. This is a bona fide gift, and there is no expectation of repayment, express or implied. But the letter alone isn't enough. You need to prove the money trail. The underwriter will want to see a copy of the check or the wire transfer receipt. They will also need evidence that the person giving you the gift actually had the money to give. This often means the giver has to provide a copy of their bank statement, showing the funds leaving their account. Yes, you have to ask your parents or your grandparents for their private bank statement. It can be an awkward conversation, but it is non-negotiable. They need to prove the money didn't just magically appear in your benefactor's account a day before they gave it to you, which would suggest they took out a loan to give you the money. A catastrophic scenario called a chained liability. Scenario number 2. You sold something. Maybe you sold your old car for $8,000 to a private buyer. Great. The lender will need a copy of the bill of sale, signed by both you and the buyer, with the vehicle identification number, the sale price, and the date. They'll also want a copy of the cash check or a bank receipt showing the deposit matches the amount on the bill of sale. Same goes for selling a boat, expensive jewelry, or a piece of art. You need a credible third-party paper trail. A handwritten note saying sold my couch for $2,000 isn't going to cut it. Now we come to the real problem child: cash. Lenders despise cash. Cash is untraceable. It is the enemy of the sourcing requirement. That shoebox full of money you've been saving for years, the mattress money, is a mortgage underwriter's worst nightmare. If you walk into your bank and deposit $10,000 in cash 2 weeks before closing, you have just thrown a grenade into your own mortgage application. There is no bill of sale. There is no gift letter. There is no paper trail. You cannot prove where it came from, and the lender is legally prohibited from using funds that could have come from illegal activities. They will not, under any circumstances, touch that money. The only way to use cash savings for a home purchase is to get it into a bank account and let it season for at least 60 days. Deposit it and don't touch it. Once 2 full bank statement cycles have passed since the deposit, the money is now considered seasoned. It's part of your established financial history. The lender will only ask for the last 2 statements, so the big cash deposit from 3 months ago will never even appear. It's now just part of your total assets. Planning ahead is the only solution for cash. So every deposit matters. Every dollar needs a name and an address. The lender is building a story of your financial life, and unexplained deposits are missing pages. They create doubt, and doubt is the enemy of approval. They need to know that the money you're using to buy the home is legitimately yours, free and clear of any secret debts or obligations that could jeopardize your ability to pay them back for the next 360 months. It's a forensic accounting of your life, and they are looking for absolute certainty. They want to see a clean, boring, predictable story. Payroll comes in, bills go out, savings grow steadily. That's it. Anything that deviates from that simple plot, like a sudden windfall from a mysterious benefactor, has to have a bulletproof backstory. And when it comes to backstories, the one underwriters scrutinize the most is the story of the gifted down payment. This is, without a doubt, one of the top 3 areas where mortgage applications go completely off the rails. You've saved, you've scrimped, and then a generous family member, your parents, your grandparents, steps in to help you cross the finish line with a gift for the down payment. It's an incredible blessing, but if you handle it wrong, that blessing can turn into a curse that delays or even denies your loan. Why? Because to an underwriter, a sudden unexplained 5-figure deposit isn't a gift. It's a giant flashing neon red flag. Their first thought isn't, "Oh, how nice, their parents are helping." Their first thought is this an undisclosed loan? Think about it from their perspective. A loan is a debt. A debt affects your debt-to-income ratio. If you have a secret loan from your Uncle Bob for $20,000 that you have to pay back, that's a monthly payment you haven't told them about, and it could be the very thing that makes you unable to afford your mortgage payment. They have to assume any large deposit is a loan until you can prove, beyond a shadow of a doubt, that it is not. So how do you prove it? You follow the sacred ritual of the gift funds. This isn't just one step. It's a multi-part process, and every single piece has to be perfect. The centerpiece of this ritual is the gift letter. This is a simple, one-page document, but it is legally binding and absolutely non-negotiable. Your lender will provide you with a template, but they all contain the same critical information. First, the donor's information, their name, address, and relationship to you. Second, the exact dollar amount of the gift. Third, your information and the address of the property you're buying. And then comes the magic phrase. It will say in no uncertain terms, "This is a bona fide gift, and there is no expectation of repayment, expressed or implied." That single sentence is the core of the entire document. The donor is signing a legal statement under penalty of law that they are not giving you a secret loan. This isn't a wink-wink, nudge-nudge agreement where you pay them back after closing. To do so is to commit mortgage fraud, and the penalties for that are severe. So step 1, get the gift letter signed. But the letter alone is worthless. It's just a piece of paper with words on it. You have to prove the story the letter tells. This is where the paper trail becomes your best friend. The underwriter needs to see the complete, unbroken chain of custody for that money, from the donor's account to yours. Here's what that looks like in practice. Let's say your parents are gifting you $25,000. First, they will need to provide a copy of their own bank statement from the period showing they had the $25,000 in their account before they gave it to you. This is called sourcing the funds. The lender needs to see that the money didn't just magically appear in your parents' account either. They want to see it sitting there, part of their established assets. If your parents just sold stock to get the money, you'll need the brokerage statement showing the sale. If they pulled it from their 401k, you'll need the 401k statement. You have to go back to the source. Next is the transfer itself. The best way to move the money is via a personal check or a wire transfer. Why? Because they both create an unimpeachable paper trail. If they write you a check, the underwriter will want to see a copy of the front and back of the cleared check, showing it was deposited into your account and cleared from theirs. If they do a wire transfer, you'll have the wire receipt. Then you have to provide your own bank statement showing that exact $25,000 deposit landing in your account. The amount has to match perfectly. The deposit on your statement, the amount on the cleared check or wire, and the amount on the gift letter must all be identical. So let's recap the perfect gift fund paper trail. 1. A signed gift letter. 2. The donor's bank statement showing they had the funds. 3. A clear record of the transfer like a cleared check. And 4. Your bank statement showing the funds arriving. When you present this complete package to the underwriter, there are no questions left to ask. You've told a complete, verifiable story. The red flag is gone. Now let's talk about how people mess this up because it happens all the time. The number 1 mistake is cash. Never ever, under any circumstances, deposit a large amount of cash from a gift into your bank account. Cash is untraceable. It's the preferred medium for illegal activity. And from a lender's perspective, a $10,000 cash deposit is indistinguishable from drug money. Sounds harsh, but that's how they're trained to think. There is no paper trail for a shoebox full of $100 bills. If your grandfather pulls 20 grand out of a safe and hands it to you, you have a major problem. You need to politely explain that you can't accept it that way, and ask him to deposit it into his own account first, let it sit, and then write you a check. The second biggest mistake in the modern era is using peer-to-peer payment apps. Do not have your parents send you a $20,000 down payment gift via Zelle, Venmo, or Cash App. While it's convenient for splitting a dinner bill, it's a nightmare for mortgage underwriting. The transaction records on these apps are often vague. A description that just says, "for the house," isn't good enough. They don't provide the robust, official documentation that a wire transfer or a cleared check does. It creates ambiguity, and ambiguity is the enemy of a smooth underwriting process. Stick to the old-school methods that create clear bank-generated records. Another critical point is who the gift can come from. Generally, it has to be a close family member or relative. A parent, grandparent, sibling, spouse, or domestic partner is usually fine. But you can't get a gift from someone with an interest in the transaction. Your real estate agent cannot give you $5,000 to help with closing. The seller of the home cannot gift you the down payment. That isn't a gift. It's an inducement, and it's a huge no-no that can blow up the entire deal. Now you might be thinking, this sounds like a lot of hassle. What if my parents just give me the money 3 or 4 months before I even apply for the loan? This is a strategy called seasoning the funds. Any money that has been sitting in your bank account for more than 2 statement cycles, usually about 60 to 90 days, is considered your own asset. It's seasoned. The lender won't ask where it came from. The paper trail requirement essentially vanishes because the money is now part of your established financial history. If you have the luxury of time and can plan this far in advance, seasoning the funds is by far the easiest way to handle a gift. The money gets deposited, you wait 3 months, and then when you hand over your last 2 bank statements, the money is just there. No questions asked. No gift letter needed. But where people get tripped up is trying to do this at the last minute. They get the gift and the lender asks for 2 months of statements. The deposit is right there on the most recent statement, clear as day. The 60-day clock hasn't even started yet. You can't hide it. At that point, you have no choice but to go back and do the full gift letter and paper trail documentation. The only way to avoid the paperwork is to have the foresight to get the gift well in advance of even starting your house hunt. Ultimately, handling gift money is all about transparency. You are not trying to hide anything. You are trying to build a clear, simple, and undeniable story for the underwriter. The story is, a generous family member, who had the legitimate funds to give, gifted me this specific amount of money to help buy a home, and it is not a loan. Every piece of paper you provide is a chapter in that story. If a chapter is missing, if you don't have the donor's statement, or the transfer method is murky, the story falls apart, and the underwriter's suspicion comes roaring back. So we've covered the money coming in. We've talked about payroll, we've talked about large deposits, and we've dissected the all-important gift funds. But that's only half the equation, because just as important as the money flowing into your account is the money flowing out. And the patterns in your spending, your transfers, and your regular payments can reveal secrets you never even thought to mention. That's where underwriters find the hidden car loans, the undeclared alimony, and the secret debts that can quietly sabotage your ability to get a mortgage. Let's start with one of the most common and most dangerous assumptions people make: that a payment isn't a debt if it's not on your credit report. You pay your friend back $400 every month for a car he sold you. It's a private loan just between you two. No credit bureaus involved. So it doesn't count, right? Wrong. To an underwriter, a recurring monthly payment of the exact same amount is the very definition of a debt. They don't care who it's to. It could be to Big Bob's Repo Barn or to your cousin Vinny. If it walks like a duck and quacks like a duck, it's a monthly debt payment, and it's going straight into your debt-to-income ratio calculation. This is the entire game. Everything we're talking about, the deposits, the withdrawals, the transfers, it all funnels down into one critical number, your DTI, or debt-to-income ratio. Think of it like this: your DTI is your financial blood pressure. Lenders have a very specific range they consider healthy. If your blood pressure is too high, meaning too much of your monthly income is already spoken for by other debts, they see you as a high-risk patient. They can't, in good conscience, give you the massive new prescription of a mortgage. So when an underwriter sees that $400 Venmo payment to your friend with the memo car payment, they're not being nosy. They're being a doctor. They have to add that $400 to your monthly debt pile. They'll add your student loans, your credit card minimums, and now this newly discovered car loan. Then they'll take that total and divide it by your gross monthly income. If that percentage creeps over their limit, which is often around 43 to 45%, you get a denial. It's that simple and that brutal. That harmless loan between friends just pushed your financial blood pressure into the red zone. Let's look at another classic example: alimony or child support. This is a legally mandated obligation, a massive monthly expense. Yet, you would be shocked how many people forget to list it on their application. They're not always trying to be deceptive. Sometimes they just don't think of it as a debt, in the same way they think of a car loan. But on your bank statement, it's a flashing neon sign. A recurring transfer, often for a significant and specific amount, to the same person every single month. An underwriter sees that, and their next step is immediate. They will stop everything and issue a condition. They'll ask for a copy of your divorce decree or court order. They need to see the exact amount and, crucially, how much longer you're required to make those payments. If you have 10 years of payments left, that amount is factored into your DTI for the foreseeable future, and it can absolutely torpedo your chances of qualifying for the home you want. But it's not just the big, obvious payments. The modern financial world has created a whole new minefield for underwriters. The world of buy now, pay later. Services like Affirm, Klarna, and Afterpay have exploded. You bought a $500 TV and split it into 4 easy payments of $125. You bought a Peloton bike and have a $39 monthly payment going to a third party. On your application, you didn't list any of this as debt. Why would you? It's just a payment plan. But underwriters are now trained to hunt for these. They know what the transaction descriptions for these companies look like. When they see a recurring payment to AFRM or Klarna, they know it's an undeclared installment loan. Even if it's small, they have to count it. And if you have 3 or 4 of these running at the same time, those little $30 and $40 payments suddenly become a couple $100 in monthly debt you didn't account for, once again pushing that DTI in the wrong direction. The underwriter's job is to connect the dots. They're looking for patterns. A one-time Zelle payment to your sister for her birthday is just noise. But a $450 payment to your sister on the 1st of every month for the last 6 months? That's a signal. That's a pattern. It suggests you're paying her for something. Rent? A loan? They don't know, but they have to find out. This is when you'll receive a request for something called a letter of explanation, or LOX. This is your chance to tell the story. You'll have to write a signed letter explaining exactly what that payment is for. If it's for a loan, you'll need to provide the terms. If you're helping her with rent, they might ask for proof you're not on her lease and aren't obligated to pay. Your explanation has to be plausible and, if possible, backed up by documentation. Simply writing "it's a gift" won't fly for a large recurring payment. They've heard that one before. Now let's talk about transfers between your own accounts. This seems like the safest transaction in the world, right? It's your money, you're just moving it from point A to point B. But even this tells a story. What an underwriter dreads seeing is a pattern of last-minute transfers from a savings account to a checking account right before mortgage and rent payments are due. For example, they see your checking account balance is $200 on the 28th of the month. Then, a $3,000 transfer comes in from savings. The next day, a $2,800 mortgage payment goes out. What does this tell them? It tells them you don't keep enough of a cushion in your primary account. It suggests you're living on the edge, that one unexpected car repair could cause you to miss a mortgage payment. It indicates a lack of liquidity, which is a major risk factor. They want to see a stable, healthy balance in the account where your bills are actually paid. Constant, last-minute rescue transfers from your savings are a red flag that you're not as financially stable as your total assets might suggest. On the other hand, let's look at your income. Your direct deposits are the most beautiful sight in the world to a lender. A regular, predictable deposit from a clearly identifiable employer, twice a month for a consistent amount. That's the dream. That's verifiable, stable income. But what if it's messy? What if you get a main paycheck, but then you also have smaller, irregular deposits from Uber or DoorDash or a freelance client? The underwriter has to dissect this. They can't just add it all up and call it your income. For side hustle or self-employment income, they need to see a history, usually a 2-year history. They need to see that it's consistent and likely to continue. A few $100s from driving for Uber last month doesn't count if you haven't done it for the last 2 years. A single $5,000 payment from a freelance project is a one-time event, not a reliable income stream. They will likely disregard it entirely. They are building a picture of your worst-case monthly income, not your best case. Every deposit is scrutinized to determine if it's a permanent part of your financial story or just a temporary guest star. So you see, every transaction in or out is a piece of a puzzle. Your regular payments to friends, family, and buy now pay later services build the picture of your total debt. Your transfers between accounts paint the picture of your cash flow and financial discipline. And your deposits create the picture of your actual reliable income. The underwriter isn't just checking boxes. They're reading the biography of your financial life, written line by line in your bank statement. They are looking for the unwritten obligations, the hidden risks, and the true story of your ability to handle hundreds of thousands of dollars in new debt. We've spent all this time focused on the small, regular transactions, the money going out and the paychecks coming in. But what about the big ones? The outliers? What happens when an underwriter scanning through months of predictable activity suddenly sees it? A single, massive, unexplained deposit for $10,000, $20,000, or even $50,000. Where did that money come from? Was it a gift? A loan from a shady source? Cash you were hiding under your mattress? To an underwriter, that single deposit is the biggest red flag of all. It's a mystery that brings the entire approval process to a screeching halt until it is solved, sourced, and seasoned. And untangling that mystery is exactly what we're going to do next. So let's solve it. The first question we have to answer is, what exactly does a lender consider a large deposit? Is it $1,000? $5,000? $10,000? The answer is frustratingly, it depends, but there is a concrete rule of thumb that underwriters use and you need to know it. Generally, a deposit is flagged as large or unusual if it exceeds 50% of your total monthly qualifying income. Let me say that again because it's critical. If you and your co-borrower are qualified using a combined income of $10,000 a month, any single deposit over $5,000 is going to get a bright red circle drawn around it by the underwriter. For some loan types like FHA loans, that threshold can be much lower, sometimes as low as 1% of the loan amount. So a $400,000 loan could have deposits as small as $4,000 scrutinized. The key takeaway is this: it's not some astronomical number. We're talking about amounts that many people move around without a second thought. Once a deposit is flagged, the underwriter's mission becomes singular. They must source it. They need to follow the money. They are operating under one of the most fundamental laws of mortgage lending. Every single dollar used for your down payment and closing costs must have a clear, verifiable, and legitimate origin. This isn't just a lender being nosy. They are legally required to do this to comply with federal anti-money laundering laws and, just as importantly for you, to ensure you aren't taking on a secret, undisclosed loan that could jeopardize your ability to repay the mortgage. Think of it like this: your bank statement is the crime scene, the large deposit is the mystery, and the underwriter is the detective. Your job is to hand them a case file so clean, so organized, and so obvious that they can stamp case closed in 5 minutes. Fail to do this and your loan application goes into a cold case file. So let's build that perfect case file. We'll start with the acceptable or legitimate sources for a large deposit. These are the good guys. The easiest one of all is your own paycheck, deposited via direct deposit. The underwriter sees your employer's name right there. It matches the pay stubs you provided, it matches the W-2. It's an open and shut case. No questions asked. Same goes for things like tax refunds. The deposit will say IRS or US Treasury. It will match the refund amount on the tax return you provided, and boom, case closed. But what about when it gets more complicated? Let's say you sold your car for $7,000 in cash to help with the down payment. You deposit that $7,000 into your checking account. To an underwriter, that is a massive, terrifying $7,000 red flag. How do you solve this mystery for them? You provide the paper trail. You give them a copy of the fully executed bill of sale, showing the buyer's name, the date, the sale price, and the vehicle information. You provide a copy of the vehicle's title, signed over to the new owner. And if you can, you provide a copy of the deposit slip from the bank showing the cash deposit on that date. With that evidence, the story makes sense. The $7,000 isn't a secret loan. It's the legitimate proceeds from the sale of a personal asset. Case closed. Another incredibly common source is a withdrawal or a loan from your 401k or other retirement account. Let's say you pull $20,000 from your 401k. That deposit hits your checking account. The underwriter flags it. The solution? You provide the statement from your 401k provider that shows the $20,000 withdrawal. Then, you provide your bank statement showing the corresponding $20,000 deposit. The two documents connect the dots. The money left point A, the 401k, and arrived at point B, your checking account. It's sourced. Now, a critical distinction here is if you took a 401k loan instead of a withdrawal. You still need the same paper trail, but this creates a new monthly payment that must be included in your debt-to-income ratio. Many borrowers forget this. They think because it's their own money it doesn't count as debt. To a lender, any required monthly repayment is a debt, period. If you don't disclose it and they see that 401k loan on your paperwork, it can throw your entire qualification into chaos. But the king of all large deposits, the one that causes the most headaches, delays, and outright denials, is gift funds. This is when a family member, typically a parent, gives you money to help with the down payment. Lenders are intensely suspicious of gift funds for one simple reason: they need to be 100% certain it is a true gift, with no expectation of repayment, and not a disguised loan from your parents. So, how do you prove a gift is a gift? You need to build an ironclad paper trail, for both you and the person giving you the money. First, you need a gift letter. This is a formal document that your lender will provide. It needs to be signed by you and the donor, the person giving the money. The letter explicitly states the donor's name, your name, their relationship to you, the exact dollar amount of the gift, and the most important sentence in the entire document. This is a bona fide gift, and there is no expectation of repayment, either expressed or implied. But the letter alone is not enough. Not even close. You need to prove the funds were transferred. This is where most people get tripped up. The underwriter needs to see the money leaving the donor's account and arriving in your account. This means the person giving you the gift has to provide you with their bank statement. Yes, you heard that right. Your mom, your dad, your grandparent, whoever is giving you the money, has to get a copy of their bank statement showing the funds being withdrawn. They can black out their account number for privacy, but they must show their name, the bank's name, the date, and the line item of the withdrawal. Then you provide your bank statement showing the matching deposit. The statement from mom's account shows $10,000 going out on Tuesday. Your statement shows $10,000 coming in on Wednesday. The gift letter connects the two. That is the complete story. That is how you source gift funds. A pro tip: the absolute cleanest way to handle this is to have the donor wire the gift funds directly to the escrow or title company, bypassing your bank account entirely. This way, you only need the gift letter and proof of the wire transfer from the donor. The money never touches your statements, creating a much simpler paper trail for the underwriter to follow. Now, just as there are acceptable sources, there are sources that are complete and utter deal killers. The number one villain is cash. Mattress money. Cash that you've been saving in a safe at home. If you walk into your bank and deposit $10,000 in cash a month before you close, you might as well have set your mortgage application on fire. There is no source. There is no paper trail. An underwriter cannot and will not use those funds. It doesn't matter if you swear on a stack of Bibles that you saved it over 10 years from your tips as a waiter. Without a paper trail, that money doesn't exist in the eyes of the lender. The other major villain is any kind of unacceptable loan. Taking a cash advance from your credit card, getting a payday loan, or even borrowing money from a friend who expects to be paid back. These are all undisclosed debts. If an underwriter even gets a whiff that your large deposit came from a new, undisclosed loan, it's game over. Your debt-to-income ratio is now wrong, your application is inaccurate, and your integrity is in question. So what do you do if you have a large deposit that you truly cannot source with a clean paper trail? Your only option is a strategy we touched on earlier: seasoning. You have to deposit the money into your account and let it sit there untouched for at least 2 full statement cycles. Usually 61 days is enough. Once the deposit is older than the 60-day window of bank statements the lender requires, it's effectively seasoned. It's now considered your money, and the lender no longer needs to ask where it came from. It's a slow and sometimes frustrating process, but in some cases, it's the only way forward. Sourcing the money coming in is a massive hurdle. But believe it or not, underwriters are just as interested in the money going out. Every debit, every transfer, every check you write is a potential clue. And some of those seemingly innocent little payments you make every month can uncover secrets that are just as damaging as a $10,000 cash deposit. And it's those outgoing payments, the hidden liabilities and the lifestyle red flags, that we need to uncover next. So let's start with the most common and dangerous one: the undeclared loan. You didn't list it on your application, but your bank statement is screaming that it exists. Imagine you borrowed $5,000 from your uncle last year to consolidate some credit card debt. You're a good nephew, so you've been sending him $250 every single month through Zelle, with the memo "Uncle Frank Loan." You might as well have sent the underwriter a signed confession. To them, that isn't just a family arrangement. It's a debt, an obligation, and that $250 a month just got added to your liabilities, potentially pushing your debt-to-income ratio right over the edge. The underwriter doesn't care if it's a formal loan with a signed contract or a handshake deal with a relative. A consistent, recurring payment to an individual looks exactly like a loan payment. And if you didn't disclose it, the first question they ask is, what else aren't they telling us? The same goes for payments to private lending companies, or even peer-to-peer lenders that might not show up on your credit report yet. They're looking for patterns. One payment to your friend for your share of dinner is noise. The exact same payment amount sent to the same person on the same day of the month for 3 months straight. That's a signal. That's a liability. Now let's escalate this. A far more serious version of this is the undeclared alimony or child support payment. Maybe you have an informal agreement with your ex-spouse. It's not court-ordered, you just do the right thing and send money every month for the kids. On your bank statement, a recurring payment to your ex looks identical to court-ordered support. This is a catastrophic red flag if you didn't disclose it. Unlike other debts, you can't just pay off alimony or child support to make it go away for the mortgage application. It's a long-term obligation that lenders take extremely seriously. If an underwriter sees these payments and you haven't disclosed them, It can stop your application debt in its tracks. They will demand a copy of your divorce decree or a legal separation agreement. If it's truly an informal voluntary payment, you will have a massive uphill battle trying to prove it's not a required liability. You'll need letters of explanation, evidence, and a whole lot of luck. But the hidden debts don't stop there. We're living in the age of buy now, pay later. Services like Affirm, Klarna, and Afterpay are everywhere. You bought a Peloton, a new mattress, a laptop, and you're paying it off in small interest-free installments. It doesn't feel like debt, right? It doesn't always show up on your credit report, but on your bank statement, it's a series of recurring payments to a financial company. One or two of these might fly under the radar. But if an underwriter sees your statement is littered with 5, 6, or 7 different buy now, pay later payments every month, they don't just see a few $100s in debt. They see a lifestyle funded by microloans. They see someone who may be living beyond their means, relying on installment plans to afford their day-to-day life. It raises a critical question in their mind. If this person needs to finance a $700 laptop, can they really handle a $3,000 mortgage payment every month, plus property taxes, insurance, and the inevitable cost of a broken water heater? It paints a picture of financial fragility. Next up is a huge one for all the entrepreneurs and side hustlers out there: commingling funds. This is when you use your personal bank account as your business account. The underwriter is looking at your statement, the one you're using to qualify with your personal income, and they see payments going out to suppliers, to shipping companies, to marketing services, or for inventory. This is a 5-alarm fire for a lender. Here's why. They have no way of knowing if the money you're claiming as personal income is truly yours to keep. How much of that $30,000 you deposited is actually profit, and how much is just revenue that has to be immediately paid out for business expenses. By running your business out of your personal account, you've created a massive cloud of doubt over your true, usable income. The lender will likely take a very conservative approach, potentially discounting your income significantly or requiring you to produce a full, audited profit and loss statement for your business, which can be a nightmare to produce quickly. You're forcing them to become forensic accountants, and their solution is usually to deny the loan rather than do the extra work. Finally, we have to talk about the lifestyle red flags. These aren't debts, but they are recurring payments that tell a story about risk. The big one is gambling. Regular, frequent payments to online sportsbooks like DraftKings or FanDuel, transfers to online casinos, or large cash withdrawals at a local casino. To a lender, this is like waving a giant red flag that says, "I make high-risk financial decisions." It suggests a level of unpredictability with your money. Even if you're a winning player, they don't see the wins. They only see the money going out on your bank statement. They see a habit that could, in a worst-case scenario, jeopardize your ability to make a mortgage payment. It's a character assessment based on your cash flow. Is this person stable and reliable? Or are they prone to taking big risks with their finances? The mortgage industry is built on minimizing risk, and a gambling habit is one of the easiest risks for them to identify and decline. So what do? All of these outgoing payments, the secret loans, the Klarna installments, the business expenses, the betting apps, they all have one thing in common. They are patterns that you can break. The solution here is proactive, not reactive. You need to clean your bank statements long before they ever get to an underwriter. This is a process lenders call sourcing and seasoning. For at least the 2 to 3 full months leading up to your mortgage application, you need to stop these transactions. Pay off the friend and be done with it. Consolidate your buy now, pay later balances onto a single card if you can. Open a separate business checking account and run all business activity through it, leaving your personal account pristine. And pause any high-risk hobbies. You need to provide the lender with 2 months of clean bank statements that show nothing but your documented income coming in and normal, boring household expenses going out. Every single transaction on your statement tells a piece of your financial story. The large deposits we talked about are the explosive plot twists. But these small recurring outgoing payments, they are the subplots that reveal your character, your habits, and your hidden obligations. Getting them under control is non-negotiable. It proves you are in command of your finances and that the income you claim is the income you actually have available to pay your mortgage. But cleaning up the individual transactions, both incoming and outgoing, is only part of the battle. An underwriter doesn't just look at a list of debits and credits. They look at the big picture. They look at the rhythm, the flow, and the overall health of your account. They are asking one final crucial question. Does the story this bank statement tells match the story the applicant told us on their application? And that final coherence check, that big picture analysis, is the last hurdle you have to clear. This idea of coherence is everything. It's the final exam. Imagine you told your teacher you spent all weekend studying, but you show up to the test with beach sand in your hair and a sunburn. The story doesn't match the evidence. It's the same thing here. You said on your application that you make $6,000 a month from your job at a tech company. The underwriter looks at your bank statement and sees a direct deposit for $3,000 every 2 weeks from that exact company. Perfect. The story matches. You said your down payment is coming from your personal savings. They look at your statement and see the money has been sitting there, growing steadily for months. Coherent. The story matches. But what if it doesn't? What if you said you have no other debts, but the underwriter sees a $500 payment going out every month to a company they don't recognize? They'll Google it and it turns out to be a personal loan company. Incoherent. The story doesn't match. What if you said your rent is $1,200 a month, but they see a check clearing for $2,000 every month to an individual's name? That raises a huge question. Is that person your landlord and you misstated your rent? Or is that a secret loan you're paying back to a family member? Incoherent. The story doesn't match. Every single point of incoherence is a crack in the foundation of your application. The underwriter's job is to see if that crack is just a cosmetic issue, or if it's a sign the whole structure is about to collapse. They will ask for a letter of explanation for every single crack they find. And your ability to provide a clear, logical, and verifiable explanation will determine whether you get approved or denied. So after this entire deep dive, what's the big takeaway? It's this: your bank statement is not just a piece of paper. It's a financial diary. It tells the story of your discipline, your habits, and your readiness to take on the single biggest financial responsibility of your life. The lender isn't trying to judge your lifestyle. They aren't judging you for buying too much coffee or for that weird online purchase. They are simply reading your financial diary to see if you are the responsible, stable, and predictable person you claim to be on your application. Your goal, then, isn't to become a different person overnight. It's to become the author of your own story. It's about taking control of the narrative before it ever gets to the underwriter's desk. And you do that by preparing. Most people just wake up one day, decide to buy a house, and hand over a chaotic mess of bank statements, hoping for the best. That's like showing up to a job interview in your pajamas. You need a plan. So let's build one right now. Let's call it the 90-day pre-mortgage cleanse. This is the exact action plan you should follow for the 3 months leading up to your mortgage application. Step 1. Mark your calendar. Pick a date 3 months from now. That's your application day. For the next 90 days, every single transaction you make is part of your audition for a mortgage. The spotlight is on. Step 2. Simplify and automate. If you have 5 different checking accounts you're shuffling money between, stop. For this 90-day period, try to run everything through 1 or 2 primary accounts. It makes the paper trail cleaner and easier to follow. Set up automatic payments for all your regular bills, rent, car payment, utilities, everything. This demonstrates consistency and shows you're organized. Lenders love predictable. Automated payments are the definition of predictable. Step 3. Go on a cash diet. Large, undocumented cash deposits are the single biggest red flag you can create. During this 90-day window, avoid depositing cash at all costs. If you get paid in cash tips, for example, deposit them immediately and consistently so there's a clear pattern. If a friend pays you back for dinner with a $100 bill, use that cash for groceries instead of depositing it. If you're selling something on Craigslist for $2,000, do the transaction through a trackable platform like PayPal or Zelle, or get a cashier's check. You need a paper trail for every dollar that enters your account. Any money you plan to use for your down payment needs to be seasoned. That means it needs to sit in your account for at least 60 days untouched, so the lender knows it's truly your money and not a last-minute, undocumentable loan. Step 4. Become your own underwriter. Right now, go and print out your last 2 full bank statements. Grab a red pen and look at them with the critical eye of a lender. Circle every non-payroll deposit. Circle any large or unusual payment. Circle any transfers between your own accounts. Now, for every circle you made, write a 1-sentence explanation on a separate piece of paper. Transfer from savings to checking to cover rent. Deposit from Venmo, sold old furniture. Payment to my brother, my half of a gift for our parents. By doing this now, you're preparing for the letters of explanation you will inevitably have to write. You won't be scrambling to remember what a transaction was for 3 months ago. You'll be prepared, professional, and in control. Step 5. Master the gift money protocol. If you are lucky enough to receive a gift from a family member for your down payment, you cannot just have them Venmo you $20,000. That will kill your application on the spot. There is a strict protocol. First, your family member must write a gift letter, a formal document stating that the money is a gift, not a loan, and there is no expectation of repayment. Your lender will provide a template for this. Second, you need a paper trail from heaven. You need a copy of the gift giver's bank statement showing the money leaving their account, and your bank statement showing it arriving. The names and amounts must match perfectly. The money should move directly from their account to yours. No stops in between. No cash. And finally, step 6. Eradicate overdrafts. For the next 90 days, overdrafts and non-sufficient funds fees are your mortal enemy. They are a giant flashing sign that says, "I can't manage my money." Set up low balance alerts on your banking app. Check your account balance daily if you have to. One overdraft fee can cast more doubt on your application than almost any other single mistake. It directly contradicts the story of you being a financially responsible person. Following this 90-day plan does more than just clean up your paperwork. It fundamentally shifts your mindset. You stop seeing your bank account as just a place to hold money, and you start seeing it as a tool for building your future. You start building the very habits that will make you a successful homeowner. Budgeting, planning, and financial awareness. You're not just preparing to get a mortgage, you're preparing to have a mortgage, which is a far more important skill. The truth is, the underwriting process feels intimidating because it feels like you're being judged. But you hold all the power. The bank statement is your story, your evidence, your resume. By spending just a few months being intentional and strategic about what that story looks like, you transform yourself from a hopeful applicant into an undeniable candidate. You're not just handing over documents, you're presenting a case. A case that proves you are ready, responsible, and reliable. A case that makes the underwriter's decision not just easy, but obvious. Your bank statement is the opening chapter to the story of you as a homeowner. Make it a story of stability. Make it a story of foresight. Make it a story so clear and compelling that the only possible ending is the lender handing you the keys to your new home.